Well, hello and welcome to the Q1 2026 webinar sponsored to you by Landmark Real Estate Management. And with me today is Kim Heisinger, the Chief Operating Officer at Landmark. Kim, hello, how are you?
I'm doing great. Good morning.
Good morning. Good to see you. We are recording this kind of at the towards the end of April, so this will be our Q1 update for everything multifamily and rental sales and investment. So let's go ahead and hop right into a few things that we're going to be talking about today. We're going to review the national multifamily market. We're also going to look at the local Bellingham and Whatcom County market. And then we're going to talk about some factors that are impacting the market moving forward. So, same type of format that we typically do. But before we get into that, we've got a few announcements at the Landmark level. And as I introduced you, Kim, as the new Chief Operating Officer, you have been promoted. You're running the whole show. You've always been running the show, but you're officially the COO. Tell us what else is happening at Landmark. There's been some
Yeah.
promotions and a few things that have been going on.
Yeah, awesome. So we also promoted Leslie Medina. So she is now our Director of Property Management. She's worked for us for several years and has been an amazing addition to the leadership team. So we're super excited about that as well. Also, just want to point out somebody on this call just got a Lifetime Achievement
Oh,
Award.
man.
So
Wow.
congratulations, Troy,
Thank
who
you.
got a
Thank
Lifetime
you.
Achievement Award from the WBA. That was very exciting. And let's see, we've made some big improvements to our leasing and marketing department. So we've noticed that vacancy rates are starting to get a little bit higher than what we're comfortable with. And so we have integrated leasing managers into each of our pods. So the way we do things here is kind of a pod dynamic. We have a property manager, a property manager assistant, and then we've added a leasing manager. So it's now a team of three. So each portfolio now has their own specific leasing manager that is in charge of all the marketing, leasings, showings, inspections for that pod. So we're super excited about adding more people to the team and getting a little bit more customized specialties in our showing and marketing realm. So excited about that. We are expanding into some new office space. So we have taken over some space next door to our current office. We're expanding over there, currently finishing construction. Speaking of, we also have hired a construction manager in our signature maintenance division. So we're very excited to start growing that a little bit more and bringing on some people in-house for maintenance. And that's Sean, who is our new maintenance manager. And then we finally partnered with a company called Second Nature, and we're really excited about what they are able to offer to all of our residential tenants. These are all optional benefits for an additional fee that tenants can sign up for positive credit building. So we'll report every time a tenant pays rent on time to help build a tenant's credits, which is super important when you're starting out as a young adult. We're also offering air filters that are shipped directly to the home, so the properties that need those. We're doing a tenant rewards, so the tenants can get rewards for paying rent on time and doing surveys, and then they'll get some gift cards that they can apply for. And then also offering identity theft. So these are all optional services that we're able to add. The most exciting out of all of these, and the reason why we partnered with this company, is we're able to now offer renters insurance. So
Mm.
currently, our lease does require that all tenants maintain liability insurance, and that helps protect all of our owners and clients. If there's a fire, a flood, anything accidental damage caused by the tenant, we can report that through the tenant's insurance so it doesn't hit the owner's property insurance. But now, for $5 more than what we're offering, the tenant can also include all their personal belongings. It covers dog bites, it covers hotel stays if something happens in the unit. So we're really, really excited to be able to offer that. Tenants can also still opt out and go get their own insurance through a private third party, but we're really excited to be able to offer that in-house as well. So lots of stuff happening,
Awesome.
and we're in the midst of pre-leasing, so we're busy leasing units up.
Yes, we are. There's a lot going on. And we're going to hear from Kim a little bit later as well when we get into the local landmark stats. So thanks, Kim, and we'll check back with you shortly. Okay, well, let's go ahead and move on. Once again, I just wanted to thank you, our clients, our customers out there that are a part of Landmark. We just appreciate you and appreciate you trusting us with your assets. And for those of you that maybe don't know about Landmark, a little bit about us. Our core purpose is opening doors and building wealth for our clients. And we do that through uniques. We are trusted, we're systematic, and we're focused on growth. And that's what makes Landmark very unique. Our core values are essentially we do what's right, we help maintain accountability. We're problem solvers. We solve a lot of problems. We've got over 55 people here at Landmark solving problems each and every day. We drive change. We're really setting the industry with a lot of different things that we're doing in our market. And we've got a lot of cool things that are on the horizon that we're working on that we hope to be talking about with you next quarter. And then finally, we serve others first. We have a four-step proven process at Landmark. We optimize the property, we manage, we deliver, and we help you grow. And so growth is a big key part of what we do here at Landmark, helping you grow your net operating income, help you grow with additional units, help you optimizing those properties. And for those of you that are maybe hearing this for the first time and would like to reach out and have a free analysis done of your property, we can help you optimize your property. We do this through a seven-step management model, and that's right there in front of you. We market, we qualify, we onboard units and tenants. We collect rent. We collect a lot of rent. We maintain, we communicate, and then we transition tenants out of the units and then the new tenants into the units. So that's our management model. Now we're going to hop in, and that's a little bit about Landmark. We're going to hop in now to the executive summary so this entire webinar is being recorded, and we are going to run about an hour, and we're going to have a lot of data for you on the market. And so, if you can't stay on for the full hour, here's a 2-minute synopsis of the executive summary. So, the national executive summary for the multifamily market 2026, going into Q2, looking at Q1 2026. I've been saying this now for a couple of quarters. It's the time to buy. It is the time to buy right now. Bonus depreciation is back and in place for real estate, and it's a great opportunity to be buying. Assets are down in value a bit. New construction is falling. It peaked in 2023. Vacancy rates are at 10 years high, and they're peaking, and they're stable. What we're seeing from quarter one, quarter of the last quarter of the year to this past quarter, we are basically flat. So they are peaking, and we anticipate they're going to start falling. Existing rents are really flat to maybe slightly increasing or stable. They're slightly increasing due to new properties that are coming on the market. So as that new Class A property comes into the market, it really raises the rent a bit. But overall, when you look at existing properties, rents are actually flat to slightly falling. So again, that's what we're seeing in the rental market. Sales are stabilizing. When we look over the last several years, we're actually down slightly in Q1 of 2026 from Q1 of 2025. That's mainly due to interest rates. That's a big part of the story there. Also on the 2026 US market, interest rates, again, there's pressure to go lower, but with recent issues and things going on, rates have not fallen down yet. We are looking at between 1 and 2 decreases potentially by year end of 2026. That's being predicted in the market right now. Cap rates appear to have topped. I think they're starting to fall down. It looks like we're going to be projecting them flat for the rest of the year and into 2027. It really depends on interest rates. And then the price per unit is starting to increase again. So we're starting to see more involvement, and we'll show you that on the graphs coming up. Okay, let's hop into the national multifamily market and let's look at that. And so we're going to look at some vacancy, rent, and unit data. First, we always talk with our pop quiz and we look at what the vacancy rate currently is. And you can see that in January of 2023, we were at 6.3%. We were climbing up in a year later and another year later up to 8%. January, at the beginning of this year, we were at 8.5%. And as of April 2026, we're still at 8.5%. So we're holding steady right now. And you can see that right here on the graph. And again, this data has come to you by CoStar. We pull that data from them and they look at units that are 5 units and up. So this does not take into account single family home rentals or 1 to 4 unit buildings. So just special note of that. And you can see that, we're right around 8.5% for what we would call all vacancy, and that includes properties in lease up. When you look at properties that are stabilized or not in lease up, the vacancy rate is about 7. So if you got an existing property, you should be enjoying more the blue line, 7% versus the overall vacancy at 8.5%. So you always have to look at the data and the numbers and what each one means. And so hopefully you understand overall vacancy with lease up properties, stabilized vacancy without. This is the amount of units that have been delivered in the last 12 months in the nation. And we're under 500,000 units that have been delivered in the last 12 months. That is down. That's a green arrow. That's positive because there's less units coming into the market. We've also we're not absorbing as many units as we're delivering. And so that unit has actually fallen a little bit. The vacancy rate is flat at 8.5%, hasn't changed from the last quarter. And then the asking rent is actually down just slightly to 0.3%. So again, that's where we're at when we look at that from a year ago to today. So pretty flat in the last 12 months, just a slight increase. This, when we take all the units, no matter if they're studios, ones, twos, threes, 4 bedroom units, and we look at them, we always like to look at the rent per square foot. And so that just cuts through everything else. And you can see that we've been trending in this $1.95 to $2 a square foot range. And we've really been sideways for most of 2023 through 2025 and into 2026. And that long-term trend line is, we're just slightly below it. We're kind of tracking with it right now. But you can see back in 2021, 2022, huge increase in rents. That post-COVID influx of dollars really impacted the market and impacted CPI and in fact impacted a lot of stuff. And you see it right here on the graph. This is the overall vacancy and rents in the US, and it kind of shows you where we're currently at. And so you can see that we're, right around 8.5, 8.4%, starting to fall a bit. And you can see that the rent per square foot overall, we're about $1.99 today, and we're projected to be by 2027 over $2 a foot, moving all the way into 2030 about $2.15 a square foot. So just kind of gives you a general trend of where we're going from a market rent standpoint. And you can just see that we're really just projected to be pretty flat for the next few years in the US. This is essentially showing you housing, new housing units. The blue line is housing permits that have been issued, and the green is multifamily, 5 units or more permits. And you can just see that, we had a big surge right after 2020 of new permits, and it's really kind of come down here recently. But this goes all the way back to the 60s, so you can kind of see where we're at. You obviously see that big increase in 2025, 2026. That was the Great Recession. You can see where we fell way down to historic lows there, really multi-year, multi-decade generational, lows there in 2010, 2011, 2012, and really kind of finding a new normal here where we're at, and pretty stable from where I see it today with permits for single family homes and multifamily. This shows you the same thing, essentially number of units that have been delivered for multifamily. Again, 5 units and up. And you can see that we really peaked in the spring of 2024. with all those new units that came online, a lot of units per quarter, and we've been falling off. New construction has been falling off, and really that first quarter was about similar to the Q4 of 2025, and really more in line with where we've been, around 100,000 units a quarter. We were double that in the spring of 2024. I mean, significantly more, almost 200,000 units a quarter being delivered. And so, really, 100,000 or less is probably what we're going to be seeing. You can see that CoStar's projecting a little bit of a bump here in the spring. That's typical where we see some spring deliveries come in. So we'll see where we're at in Q2 of 2026, and then really projected to be falling off between the 50 to 75,000 units per quarter delivery through 2029, unless something happens. Obviously, interest rates come down, something changes. These numbers can change dramatically based on new construction that will come online. But what we're doing and what we're anticipating is that we're going to be absorbing the supply that's currently in the market, and then we will be building less units, and those vacancy rates will be projected to start coming down because of the less units being delivered in the market. From apartmentlist.com, I always like to show you a couple of resources. And Apartment Lists has the median rent of all units throughout the US. And this takes into account all units, all bedrooms, all sizes. And again, we've been kind of trending sideways to slightly down, as you can see, where that average unit rent per month is just about 1360 a month. Here's the long-term trend line as well for that particular. You can clearly see in 2021, 2022, just a huge increase to well over $1,400 a month. This is the year-over-year growth. So essentially the same chart as you saw, but just looking at the trend in the change, the rate of change. And you can see this graph, when people ask what happened during COVID, I show them this one. And this is where you just see that rents just skyrocketed. Everybody wanted to rent a unit. There was a lot of money pumped into the system, a lot of new units and studios delivered, and rent increased dramatically. And you can see it here. And then we came right back down. And really, since the latter part of 2023, we have been below zero as far as rent growth. We have been trending down. So, and that's on existing properties, not new properties in lease up. This shows you by month, the same graph, again, just showing you that the month over month growth in the US is very cyclical too. So when you look at that last graph, it's showing you kind of a 12-month average. Here you see the intricacies by month. And so you can always see that we have a spring, where rents start to increase because new products coming in line, we're turning units at those times, and you can see the dramatic changes. But obviously, the second half of every year, we always see a decline. So again, when those are averaged, you see this overall chart, but quarter by quarter or month by month, you see the intricacies of the market. So that spring season is always a great time to be bringing properties to the market. And you see usually rents start to increase a bit because more and more people are renting. The second half of the year, the fall, around end of the year, hard time to rent. A lot of people aren't moving at that time. And so you see more concessions, and actually rents go backwards a bit. This is the overall US vacancy rate. Again, tracking very similar to CoStar's number at 7.3%. And so you can just kind of see, and again, this is based on apartmentlist.com. CoStar has that 5 units and up stabilized market at 7%, and Apartment List has it at 7.3%. This is a great graph that just shows you the time it takes for a unit to rent. And we have been trending up since that, I would say, where we were pre-COVID, we were between 25 and 35 days, that range, and we dropped way down under 20 days to rent a unit. And we have popped way back up to, we hit over 40 days to rent a unit here at the end of the year in the first quarter of 2026. Now we're falling down. A little cyclical, as you can see too. More people renting in the spring, and then that later part of the year, the days to rent take more time. So this is a great graph for you to understand and see seasonally and what the changes are from trying to rent a unit the first half of the year versus the second half of the year. But overall, we're at about a 7-year high today when it's in the US to rent a unit. Okay, key stats in the national multifamily market. Hey, Q2 2024 was our top for multifamily construction. New permits and construction is really slowing 5 quarters in a row. Absorption of units is stable, increasing depending on the size of the inventory, but kind of flat to overall. Due to new supply, the time to lease is a 7-year high, as we just saw in that previous graph. Rents are starting to increase slightly with new supply, just the new supply. Existing supply is flat to falling. Okay, let's talk about sales data in the US. So let's look at some sales data. Love to show you the volume, which is the orange bars, and then the line is the price per unit. So you look to the left, you'll see the market sales price per unit. And then on the right, you see the volume in billions of dollars by quarter. So again, a lot on this graph, but you can just see that, the first quarter of the year, that last bar, pretty flat, nothing to write home about, just above $20 billion in sales. Down dramatically from where we were in 2021. You can see that second, third, fourth quarter of 2021 was a record year where we had almost 120 billion in sales in one quarter. Just incredible. And the more sales there are, you can see that the price per unit went up as well. So we went from in 2020, 210,000 a unit to almost 270,000 a unit. And we've been falling back down. We stabilized just under 230 a unit. And now we're above that 230 a unit line and projected to start going higher into 2027 and 2028. So again, peak spring 2022, and you can see that record sales volume there, that big, huge bar of sales. Lots of portfolio sales during that time. It was just a crazy sales cycle. And then the low, really, from a volume standpoint, is in back in the first quarter of 2024. That was the low bar for overall volume and starting to pick back up again, as you can see by some of these sales. We hit in the last quarter of the year was the first time we hit over 40 billion in sales in one quarter, and it was a healthy quarter, very, very healthy quarter in the U.S. Again, this is the same graph, and I'm just looking at that trend starting to move back up over the next few years, moving up. And I just think that that's why I'm saying that it's the time to buy, because I'm projecting to see values start to move up and see some pressure on values building over time. Okay, key stats. We peaked on the sales in the spring of 2022. Values have pulled back a bit, as you've seen, and they appear to be stable and now increasing. New supply of units is slowing. With reduced new construction, values will continue to increase and ideally potentially set new highs in 2028, 2029. It's the time to buy. Okay. Also, in the recap on the sales part for the US, transaction volume is really flat from the Q1 2025 to Q1 of 2026, the last 12 months. But we had that nice record, 3-year record in the last quarter of 2025. So again, good signs of sale volume occurring, and that's pushing prices up a bit. Sales are down 60% from the peak of 2022. The market is still adjusting from all that new supply. Let's talk about capitalization rates. Again, a cap rate is really your rate of return if you pay cash for a property. It's the indicator of NOI to the sales price of a property. And so when we look at that, you can see that you want to buy at a high cap rate and sell at a low cap rate. The lower the cap rate, the higher the value. The higher the cap rate, the lower the value. So values have been coming down a bit and cap rates have been moving up in the last few years. And we're really showing cap rates pretty flat for the last 2 years and projected to be flat to slightly decreasing. And you can see the US average, the green line there, just below a 6.2 cap. And you can see the blue line, which is those 4 and 5 stars, those premier properties, they're closer to about a 5.6 cap. So again, just giving you some indication of where cap rates are in the US market. Spring was the low of 2022. That low was below a 4.4 cap. Really an incredible time of just all-time lows in cap rates. And that's when values were at the highest. That end of the year 2021, spring of 2022 market. Just an incredible, crazy time. So let's talk about a summary here again for the multifamily market. Construction boom and peaked in 2024. Rents are flat to slightly increasing with new product. Vacancy rates are peaking, flatlining now. Sales are slightly increasing. And then loan to values really is the story here, as I've been telling you for almost a couple of years. They've decreased from 70 to 80% loan to value with those low rates of 3 to 3.5% to really the 55 to 60% range with rates at 6 to say 7%. Fannie Mae rates, you can get down into the mid to high fives is what I'm starting to see. But again, check with your mortgage banker or your broker on current rates. But when you have to put more money or more equity into the deal, it's just not as many people are buying investment property. And that's the real story here. Cap rates are starting to top out, very interest rate driven. And the price per unit or the value per unit has been falling since it's really that peak of Q2 2022, but they appear to be bottoming out and then moving back up again. Okay, let's talk about the Bellingham market. Bellingham, Whatcom County market. This is the exact summary. 2026 Q1 summary. New construction driving up vacancy rates to really over 10-year highs, albeit we're starting to fall a little bit here recently. 2026 is slowing on new construction. It's harder to pencil deals locally with today's rates and construction costs. And we're seeing that story throughout the nation, really. But locally, we're seeing a lot of that. Vacancy rates have peaked and coming down, as you're going to see. And then the overall rent per square foot is increasing slightly again. It's been pretty flat, but increasing slightly. And sales, really pretty normal, other than a couple of big spikes in Q3 and Q4 of 2025. We had a couple of just real large deals, and we'll show you those deals here in a minute. Also, on the exec summary, cap rates are really leveling out now, as very similar to the US market. And then new regulations at the state and local level have been put in place in the state of Washington and also in Bellingham, and we've been telling you about those. And Kim will update us a little bit more on those and some changes that have recently happened here shortly. Okay, vacancy rate for Whatcom County, Bellingham, Whatcom County. Again, back at that low of January of 2023 of 2.4%, we popped up dramatically a year later to 6.6. Kind of falling, kind of bouncing back and forth between 6.6 and 6.1. Beginning of the year, we were at 6.4, and we're now back under 6% for the first time in almost 3 years to 5.9%. So that's healthy. This you can kind of see where we're at. Again, the orange line is the overall vacancy, right around 6%. And then you can see that stabilized vacancy is now actually just under 6%, right around the 5.7% range. We peaked way back in the first part of 2024 to almost 9% was our overall vacancy. Again, overall vacancy includes properties in lease up. The blue line, the stabilized vacancy is properties not in lease up or already existing properties. Here is the same CoStar data again for 5 units and up in Bellingham. We delivered 82 units in the last 12 months. That's down from the last quarter. We've absorbed It's down, but it's actually more. We've absorbed more units than we delivered. So that means the vacancy rate is coming down to 5.9%. So that's a positive thing. When you absorb more units than you deliver, vacancy goes down. If you deliver more units than you absorb, vacancy goes up. And then that average asking rate is actually back up over 1% now at 1.1. And so that's increasing. So again, positive for the local market. Here is kind of some indicators. This shows you a breakdown of vacancy based on 1, 2, 3, and 4 and 5 star units, and you can see that the 1 and 2 star, kind of your less quality buildings, older buildings, tend to be have the highest vacancy rate, whereas the 4 and 5 star, the newer properties, have the lowest vacancy at only 4.2%. So again, depending on the quality and the star rating of that property, you're going to be experiencing a different vacancy rate. A lot on this graph, I know, but I love this graph. Again, the orange bars show you absorption, how many units have been absorbed. The blue are how many units we've delivered at the bottom. And then the green is the Bellingham Whatcom County vacancy rate. And the yellow is the US vacancy rate. So we're below the US vacancy rate, and we have been for 2 years. We've got a big project that's going to be delivered. Probably it's been moved like a couple of quarters now, and so it's now being delivered at the end of the year 2026, and that'll bring on 350 units. And so CoStar's projecting that the vacancy rate will pop up a little bit, that overall vacancy rate. This is the rent per square foot. Again, we showed this to you for the national market. That national, we're at $1.95 to $2. And here in Bellingham, we're right around that $2.25 a square foot range. And again, we're slightly below that 5 year average, but again, starting to move back up again, which is positive. We were really declining, I would say the latter part or the second half of all of 2025 and stabilizing, and now we're moving back up. Let's talk about some sale data in Bellingham. Again, in the last 12 months, 15 sales, average price per unit of 232,000 dollars, almost 10 million in sales, and the average vacancy at the time of sale was almost 8%. And you can see those units there. And here, there's that one big sale that we had here of over $50 million. We had another one at $47 million last year. So again, big sales that occurred. You can see Barclay. That one was the most recent sale right there. Barclay Trails and Barclay Park sold for almost $48 million. And then that Kerf Apartments right above it is the big one that sold in the quarter before in 2025. So a couple of big sales, kind of unusual, set some new records, but really just kind of a couple of one-off deals that occurred. This is the sales volume per quarter, and then also the price per unit. So you're going to see that sales volume as the orange bars at the bottom. That shows you the sales in billions. I'm sorry, millions. So you can see those two big sales, those two big spikes in 2025, record sales, really just a couple of sales in each quarter that drove that market up dramatically. Whereas typically we're kind of down, any quarter between, 3 and 5, 6, maybe as high as 10 million in sales in a quarter. So again, couple of unique skewed bars there that again, I think we can kind of throw out as one-offs. But you can see the blue and the green lines. The blue line shows you the price per unit in Bellingham versus the green, the price per unit in the US. So again, we're slightly below the price per unit in the US, but we're projected to move up and make new highs in 2028 and 2029. Hence why time to buy. Cap rates, almost an identical graph to the US, very, very similar, albeit I've got the yellow one on here shows you the US cap rates, and the Bellingham cap rates are actually a little bit below the US. So more desirable market, Bellingham than the US as a whole. And you can see that on this graph. Not a lot of discrepancy between, 3 and 4 and 5 star units. You can see that we're kind of, all over. We're anywhere from 5.6 to 5.5%. Very, very close and tight range. US caps again, and then those are the Bellingham cap rates. Okay, that is the US market, the Bellingham market. We're going to talk to you, bring Kim back in now. We're going to talk about some landmark data. So, Kim, how are we doing at landmark compared to Bellingham and the US?
We are doing above average.
Wow.
So, what is Landmark's current vacancy rate? Well, today we are at 2.8%. This includes new construction lease up. Last quarter, when we reported to you, our vacancy rate was 3.6. So, we're definitely trending in the right direction. And that is kind of to be expected this time of the year. It's a really good time of the year to do move-ins and move-outs, spring and summer. So, um, that's where we're at. Their last quarter, excluding new construction, we were at 2.9. Today we're at 2.4. So again, trending in a good direction there. And then if we look at our year-to-date average vacancy, we're at 2.78%. And last quarter, we're actually at
Mm,
4.1%. So
mm.
all of those are trending in a good direction. Good time to be a Landmark client.
Is that seasonal, do you think? I know the last quarter we always look at in that fourth quarter,
Yeah.
there's obviously it's a harder time to rent as we saw from the US. And so do you just tend to see seasonality with the landmark portfolio where vacancies are a little higher or was that an anomaly this year?
That is a great point. So yes, typically around the holidays, the end of the year, winter months, we do have a little bit tougher time leasing up vacancies. Now, you might see an increase in vacancies coming up here next quarter just because we have so much unit turn.
Mm,
So that vacancy is really just looking at the downtime. So most of our units are pre-leased, so there's currently a tenant in place. They're already re-rented, but you're going to see vacancy because of the downtime to turn that unit and
yeah.
get it ready. Where in the winter months, it's more real vacancy where we're sitting, we're actively marketing, and people just tend not to move that time of year. So great question.
And you really see we have two distinct seasonality issues in Bellingham and Whatcom County, where you've got, I would say, the typical, which the nation experiences, that late year, that fourth quarter doldrums of it's just harder, not as many people moving. And
Mhm.
then we've got a lease up period because we're a university town. And so a lot of people, June, July, August, September, are moving.
Correct.
So, but really which is different than most markets in the US. It's a university town seasonality, if you will. So,
Right. Yep. Okay, so our next graph is showing us what our landmark portfolio price per square foot is looking like. So, looking at these numbers just compared to last quarter, our studio price per square foot was down by just a penny. Everything else was up except for five bedrooms also went down by I think by 2 cents. But the one beds, the twos, threes, and fours all went up slightly in their price per square foot. And then our next slide shows what is our average rents per bedroom size. And those have the little arrows that kind of show you from last quarter, did that increase or decrease? So you can see here our one bedrooms did go down slightly, and our four bedrooms went down slightly. All other unit types did go up.
mm,
So those are, yeah, I know people really like that slide.
yeah,
So
yeah,
maybe go back to it just so
yeah,
people can take a screenshot if
yeah,
they want.
right.
And
That's
again, these
good. Yeah.
are averages by
Mhm.
bedroom size. This doesn't include square footage. Some properties we don't have square footage on necessarily. So this is just looking at bedroom size. So this is really um, comparable for student housing. Often
Mhm.
they're really looking at how many
So, so
bedrooms.
interesting. Like the studio overall price went up a little bit, but the studio rent per square foot went down just a smidge. So depending on the size of the units in the mix, might have tweaked that just a little bit. But we saw a lot of studios come to the market in the last couple of years, and so that market's been saturated and still working its way out, would you say?
Yes, agreed. And we saw a lot of what I like to call micro studios come on the market. And they
Mm,
really aren't micro when you're looking at it on a national level because there are very small studios you'll see in Seattle area. But when we start getting below 500 square feet, that's considered small for our area. That's kind of a new thing that we're seeing. But they are renting, but then of course you're seeing the price per square foot go up, which is
right,
great. So,
right. Interesting.
yeah. Legislative updates. So we got a lot. So let's start with the best one, the positive one. House Bill 2452 and House Bill 2664, they modified the legal service requirements. So effective mid-June, I think it's June 11th to be exact. This was the biggest win for our industry in this session. Property managers can return to using first-class mail instead of certified mail for legal notices. And not just that, we no longer have to physically go out and attempt personal service. So this is huge. We had to hire a full-time employee. This is all that they did. You should see, Troy, the stacks of certified mail that get returned to us. So anytime a tenant was going to have a renewal put in place, we had to attempt personal service and send certified mail to each individual that lived in the unit. So it was kind of a silly law that passed, and everybody is very excited to be done with that and just go back to email
So
and regular mail.
you're saying the state made a law last year in 2025, and they actually were smart enough to hear from people on the realities of how things actually work, and they fixed it.
Yes, that
Uh,
was a
so
big
there
win.
is some sanity down in Olympia, is what you're
Yeah.
telling me. So
Yeah, so this
okay,
saves tons of time, money, and makes the process more convenient for tenants. So that
right.
was a unanimous, everybody was excited about
Well,
that,
and people
tenants
weren't
and
people. A lot of
landlords.
people didn't even know about it and weren't even abiding by the law. So
Right. And
I
that was
mean,
really
yeah,
scary because then
yeah.
you could have a signed renewal that a tenant could void at any
A lot
point.
of legalities with that rule and a lot of unintended consequences that I think people just didn't really understand when they created the rule. The intent was to provide communication and transparency, which still exists in the market today. It's just the reality of sending certified mail and posting notices isn't how people operate today. And so
Correct.
they changed it.
Yep, exactly. There is a Senate bill that passed 6200 for portable cooling devices. Basically, landlords must now allow tenants to use portable air conditioning or cooling units with some reasonable exceptions. Specifically, if a building's electrical system can't handle the load or it's blocking the egress window or there's potential safety hazards. So we are ensuring that our lease language is brought into compliance for that. There is Senate Bill 6237, flood risk disclosure. So if your property is located in a flood zone, you are required to disclose that to tenants. And the disclosure must also clearly state that the insurance does not cover the tenant's personal belongings. And that renters have the option to purchase their own flood insurance. So again, we're working on those disclosures. Our lease already does disclose that tenants' personal belongings are not covered through the landlord or landmark. So we're covered there. We just need to get a list of which properties are in flood zones. Of course, many of you heard of Senate Bill 6347, the millionaire's tax, primarily aimed at individuals owning over 100 or earning over 100 million annually. This bill obviously has potential implications for our industry. Provisions that disallow certain loss carryovers could discourage new housing development in Washington. Some high-income property owners may also consider relocating their primary residence out of state. So we're continuing to monitor that one. And then finally, Senate Bill 5937. This one is smart access systems, doesn't affect landmark clients, but worth noting. It regulates building access systems that rely on biometric data, such as fingerprints or retina scans. So we don't have any properties that utilize that. So at this time, it doesn't apply to us, but just important to note. So those are what happened in legislation. We actually sent one of our staff members to a day on the Hill for I think she went for a total of 4 days and went and spoke to legislators. And so we are on top of that, staying involved and fighting for our property owners' rights
There's
and
a
best
lot
interests.
at the government affairs level, and we're really staying on top of everything. We've got a couple of people committed to it, and so if you have questions, if you want to know about the law, if you are not a Landmark client and you want to reach out, you definitely can. You can call Kim and talk to her about how the laws work, or if you need a free market analysis of any of nature, you want to understand how to optimize your property. Kim can do that for you. She knows how to do it, and this is what she's been doing for close to 20 years. So
Yeah.
thank you,
Yeah,
Kim. Yeah.
it can be very complicated. So, again, I mean, not an attorney, but I can definitely tell you best practices and explain the way that we're handling certain things and provide resources.
Right. Well, thanks, Kim. And hopefully
Yeah.
somebody reaches out to you if they've got any questions. They can definitely do that. And we appreciate your insights at Landmark. And thanks for all that you're doing. So we're going to continue now on with the rest of the webinar, and we're going to move into really our last section, which is just factors that are impacting the market and kind of looking forward. So for conclusion purposes here. Biggest issue, and this has been on for 3 years. The number one factor, interest rates. They continue to be the number one factor. This is a chart of the 10-year Treasury, and as of today, mid April here, we're at 4.25%. We've been kind of moving up and down with some of the things happening in the Middle East and such, but right now we're about there. Again, the 10-year Treasury is a great number for you to monitor and watch. Interest rates tend to be right around 2 percentage points above the 10-year Treasury. So to get a 10-year rate, 2% a percentage of points above 4.2 is going to be about 6.25. That's about the 50-yard line for your interest rate. Now, you might see something in the high fives, you might be something in the mid sixes, but again, that's a good rule of thumb for you to just know a little bit about where rates are at commercially. Single family rates are close to that, but they follow a little bit longer term rate. Investors expect the rates to be cut more, and so we're showing that kind of by year end we could be in the 3.75, 3.5% range. We will see. Right now we're about 4.25, so we're a little bit above that 4.4 where we're expected to be right now. So again, this just kind of shows you the expectations of investors. You can see where we were back in 2020, 2022. The Fed funds rate essentially at zero. Rates were really at all-time lows. Huge, huge impact for the market. So again, rates have been flat to slightly declining over the past 3 years. Shelter inflation, a lot of people talk about this one. This just shows you the year over year change in shelter inflation. And really, you can just see that most recent huge bump in inflation where we shot up to almost 9% and we're falling back down to really more normal levels. We're still above the 2% range, just slightly below 3%, right around 3% actually. But again, people want to see us right around the 2% range. Ideally, 2 to 3% is kind of a safe zone. We're still dealing with the ramifications of that huge increase during 2023, 2024. So renter demographics. This is kind of an interesting chart that's brought to you by Marcus and Millichap, great, very well-respected commercial brokers. And they are looking at kind of the demographics that are shaping the needs of multifamily moving forward. And that millennial generation is just driving the demand. And you can kind of see where they're at and the age and where they're going to start to look at buying a first home purchase. And so you just kind of see some trends that are starting to occur and where those renters currently are and where they're going to start moving out and buying homes. And so again, they're driving demand. And that first time home buyer age has increased. In 2025, it was an all time high of 40 years old. And so, again, little older now to try to buy a home. And so they're staying in units longer. So, again, interest rate driven. Cap rates versus interest rates. This is a great graph that just shows you where that cap rate is, average apartment cap rate versus the 10-year treasury. And right now we're about 4.3, 4.25 as you saw before. And then that cap rate. You kind of see the spread and the difference between the two. So those cap rate, which is your rate of return if you paid cash for a property, right around 6% now and in the nation. And you can just kind of see the difference. And when the market's really, really tight, that thing narrows. When the market is stressed, like during the Great Recession, and sales volume starts to drop, then that spreads dramatically. And so that spread is somewhere between 200 and 300 basis points. And right now it's, right around 170 basis points difference. But again, it expanded to almost 500 basis points during the recession. So again, and those are good times to look at buying. Here again is just that downward trend that we've been on cap rates and where the treasuries are. Just kind of shows you the trend line. We're a little bit above that right now, but again, interest rates have been the story of the last few years. This just shows you the changes in transaction velocity linked to cap rates. And you kind of saw this on the volume bars that I showed you for the US. When volume spiked in 2022, 2023, cap rates went down. So again, and you really see that right here where that those cap rates dropped dramatically when transaction volume on the left shot up, the blue line. Let's talk about local inventory. This comes to you from mid-April. This is right from the city of Bellingham Permit Center, and it just kind of shows you where we're at. I always like showing this graph for Bellingham. Units filed in the last 6 months down slightly from where we were last quarter. That's a green. That's positive. But under construction, we're up just a little bit from where we were the last quarter. So not much, but just a little bit. And then units in review are down just a little bit from the 255 of where we were before. Let's talk about the single family home market. And we're just looking at residential homes only. And we like to look at a couple of charts, mainly the median sales price and then inventory. Here again is the median sales price. And this just shows you the orange line. The top one is the Seattle market. The green is the Bellingham market. And then the purple is the Whatcom County market. So you kind of see where we're at. And we've been flat to slightly increasing here in Bellingham and Whatcom County. This shows you the closed sales. And so you can see sale volume here. And again, kind of down from where we were during the craziness of 2020, 2021, 2022. We've fallen off and we found kind of some stability here. Ideally, we're below really that 30, 40-year average when you look way back. But again, we're starting to build and definitely form a base. This is the homes for sale right now. And again, the red is the Seattle market. How many homes are currently on the market? The purple is, again, Whatcom County. I'm sorry. Whatcom County. And then the green is Bellingham. And so you can see that we're really well below. When people ask me, hey, like, where are we compared to the Great Recession? This is the Great Recession bar right here on the left. And you can kind of see where we are as far as housing units available. We're still well below those numbers today, albeit we've been increasing over the last 3 or 4 years. We still have a long way to go to get back to where we were at Great Recession levels. Nationwide homes for sale. Again, this just shows you that we're really way down at the bottom here of where we're at, about 4.2 million. This is per Redfin. We were well over 6 million sales and approaching 7 million sales during the craziness of 2021. So we're way down from that. We need to be closer to 5 million, 5.5 million to be more stabilized, I would say, and along the long-term trend line of where we should be. And that's interest rate driven. Let's talk about nationwide home sales. This number's down a little bit from where we were a quarter ago, but we're still increasing. And so you can just see the total U.S. homes for sale. And again, just a very few homes for sale during 2021, 2022, 2023. We hit a low of 350,000 homes for sale. I mean, there just was nothing on there. And that's why that bidding war was increasing. That's why you saw prices skyrocketing, craziness. The average over really the past almost 10 years is about 820, and we're just slightly above that today. Housing starts. I showed this graph to you before. I like to bring it in again. And this just shows you again the blue line, residential housing permits, and the green is multifamily, 5 units and up, and really pretty stable right now. You can see the big swings during the Great Recession, pre and post, and then also COVID pre and post. And then lastly, let's talk about home affordability versus rental rates. And this just shows you, I've showed this graph to you multiple times, and we built this graph from scratch here just to kind of show you where we're currently at, based in February data. It's about $625 of a premium to own versus renting today. And so you can see the red is the cost to buy and the blue is the cost to rent. And that's basically based on interest rates. You can see 2013 through 2019, it was almost the same, really the same. And so we've got a big spread right now and starting to narrow. The peak gap was over $900 back in October of 2022. Okay, let's talk about a summary and conclusions. Again, Bellingham, Whatcom County, vacancy rates remain lower than nationwide averages. And again, we dropped significantly here from last quarter to the current quarter. New construction locally has pushed vacancy rates back to normal levels. Vacancy rates are starting to decline. And higher interest rates have kept people in their homes longer. And the first-time home buyer market is at an all-time high for age right now. So again, more people are renting. Housing payment to rent gap is high, as you just saw from that last graph. Not at an all-time high, but it's still significantly higher than where it has traditionally been. So again, people are renting and staying in the rentals versus buying homes. Home sales are down and apartment demand continues to be strong, albeit with all the supply on the market. Long-term real estate outlook continues to be positive for Whatcom County, the Bellingham market, and we're continuing to see that. So again, I think it's a time to buy. Multi-sales are flat. Again, we had a couple of big bars there with those big sales, but really they're pretty much flat, both locally and nationwide. Whew, a lot of information, or just over an hour for our webinar. I just thank you very, very much for you that are our clients. We appreciate you and we thank you. And for those of you that are just watching us, thank you for joining and watching the webinar to the end here. If you have any questions, feel free to reach out to Kim, our Chief Operating Officer, or myself, the owner of Landmark Real Estate Management. That's both of our direct lines there. Happy to give you a free market analysis. Happy to show you how we can optimize the property for you. We are committed to understanding the market and communicating that to you. So if there's any questions, feel free to reach out to us. Thank you again for joining us for our end of Q1 2026 webinar. Have a great rest of your day and rest of your year.